Welcome to this special edition of Bullish on Business. This is your host and certified master coach, John Randall. Our special edition today, we're going to be talking about foundational advice. If you haven't heard of this, you must be living under a rock somewhere because it is a massive initiative for Ameriprise. It's a big deal to them, and so we're making it a big deal here at D2. So I at least wanted to frame what the heck this is and how to think about it. We're going to hear from one of our experts today that's further down the road with this, but we've also got some advisors who are new or who are just kind of dabbling or just hearing about it for the first time. So we have one of the top advisors in Ameriprise, Scott Livefried. Scott, welcome to the call.
Oh, thanks, John. Good to be here.
So Scott's in Iowa. Scott was part of a pilot, and so he's got one of the biggest head starts of anyone in D2 or anyone in Ameriprise. So we're going to hear from him how hundreds of these have gone, how he's thinking about it, how he's using it, what he's saying to clients, and what clients think about it so far. But it's important to think of this, what it is, and have our mindset in the right perspective for what exactly this is. The main premise is to get advice for all clients front and center at all times. So when your clients that are doing planning, this is a way we can get their plan part of the website experience when they log in to look at their accounts. They're not just looking at their accounts, they're seeing how am I doing towards retirement, whatever their big goal is. Most of the time it's retirement. So that's really the key, and it's updating live. They're seeing their financial plan live. They're not getting that one time you run it a year. They're seeing it actively in motion. That's the value of having this tool out there. Now, for those of you that have some clients that are not doing planning, not engaged in advice, this is a way to build a moat around the assets that are there. Those clients that you have just doing asset management, no advice at all, some kind of advice is the moat that keeps assets here. So Ameriprise has figured that out. They've seen what a lot of other firms are doing, adding this to keep the moat around their clients and their assets. So that's the purpose here. So it's to get some kind of advice on the website for everyone at all times. That's really the whole goal here. Your existing planning clients doesn't change. It just gets their advice front and center. People not paying for planning, that's okay. That's a super quick, easy, free version. And we'll hear a little bit more from Scott to get his insights on it. So let's just think about it that way. But let's dive into this with you, Scott. You've been down this path a lot further than us. So how are you thinking about foundational advice, and what's your mindset going into this?
Well, first of all, I think it's important that we not confuse the paid planning clients, and this is not a takeaway from those relationships. Those relationships are separate. To frame it up with the foundational advice clients, by and large, these are clients who have been clients for a while now. They may have come on from an acquisition from another practice or in from another firm. And a lot of how a client starts their relationship with the advisor tends to be how it stays. And so if that relationship started as asset management only, a lot of times it may stay asset management only. And with the foundational advice, and really I don't like to even call it advice, I call it an assessment. This is a way for us to add value to our good asset management only clients, and it can shift the conversation to their goals. But one of the things that we have to remember is this is an add-on, add value for asset management clients when we're talking about the foundational piece. So this is not for an extra fee or an extra cost. We have to be careful that we're not consuming too many resources in our practice outside of the client meeting. And this is one thing that's so important. What I'll tell my team and what we focus on is if it takes much more than 10 or 15 minutes outside the client meeting to facilitate a foundational assessment, now we're entering into the realm of paid advice. And so it's important to, show the clients, this is good, this is more than you've ever had, and we can also point out where its shortcomings are, and that can motivate people to shift into a comprehensive advice relationship or not. But it's really important. It's a fine line of paid planning versus this foundational assessment. But the big thing is that they can see how they're tracking a goal with the online experience.
This is great. It's a great way to think about it. I think it's important that we're not wasting too many resources, as you said, for people that aren't paying for the advice. But it's a great term to think of it as an assessment to get something out there, get the conversation started. And look, here's what Ameriprise is realizing, that we give people a taste of this. People might want more. They might want to upgrade to formal paid financial planning with you. You might find some more assets. You might find some other opportunities out there with people. That's the byproduct of this, is kind of upgrading folks and finding some more things out there. So let's peel it back a little bit deeper here. And I think that, to your point, not taking up too many resources. When it comes to planning, a lot of us like to strive for perfection, where we should really strive for excellence. So what's your thoughts on just, it's okay if it's not perfect, just getting it out there? I mean, how are you thinking about this when it comes to the accuracy of what you're dealing with?
Sure. We're doing this on the fly in the meeting with the client. This is a conversation that the tool, whether you're using Money Guide or Naviplan, it really doesn't matter. It's the tool helps guide the conversation. And so we're having conversations around longevity, and we're having conversations on what we might spend in retirement. And I think it's important not for us to get hung up on, the details on what are you going to spend in retirement. We ask the client, what do you think you're going to spend in retirement? And they'll have a conversation, and I'll know going in about what is realistic. A lot of times the client will be, really unrealistic on how little they'll say they'll spend in retirement. And so we'll talk through that, and then we'll agree upon what is the best estimation based on our conversation today. And then we go with it. Same as, we go to get to the Social Security part or the pension part. If they don't have that with them, we have a conversation. We'll agree on what approximately it's going to be, and then we go with it. And so, and we move on, and we go with these agreed upon assumptions. And all through, I'm pointing out to the client that, hey, this is our best estimate in comprehensive advice. We drill down and get much more accurate with this. And so all along, I'm bringing out the differences between this version and what we do when we do the comprehensive thing. And many times, clients are just fine with this version, and that's great. We move through it, and we're not spending any more resources than we would have otherwise. But it's really like great conversations with clients, and I would really encourage everybody to go through this with especially clients who are already well into retirement.
Nice, very nice. So it really seems like it really is any client could do this, and every single client should have this conversation.
Exactly, and you'll see here, I wouldn't discriminate on who you do it with or who you don't go through this conversation with. I just everyone, especially the non-planning people, and really, even if it's a phone meeting or even if you have data on them already, do your best estimate to go through an assessment, even if you haven't had the chance to have the meeting with them yet, and you can publish it, and then you reach out and saying, hey, I uploaded this assessment that we did. to your online secure site. And I'd like to go through it with you at some time to go over the details, because I'm sure we're going to be off on certain assumptions, and we'll have a conversation around it. So you could really, and we've done some of this too, is we'll publish it first and then go to the client and say, hey, let's talk about this.
That, I think, is a great way to get ahead of this wave, is just get it out there, publish it, and then talk about it with the client. So to wait to deliver something new to a meeting, it'd be great just to get it out there now and then talk about it in the meeting. I think the people I've heard that have done this, it's engaged clients more, and they've gotten some disengaged, non-planning clients saying, hey, I've been playing with this tool, or hey, I was on the website and I noticed this, and or you put in this number, it should be that number. Yeah, hey, now we're scraping into this might be a planning candidate to get more engaged. But I love this concept. Let's just get it out there. Let's publish it. Let's do as many as we can, and then we'll talk with people about it as we meet with them. We have phone calls with them. I think that's a big way to get this ball rolling, because you'll see your Ameriprise people, your field vice presidents, they have a fire lit under them to get this going. And you want to be in good spirits with them and keep them off your back. I mean, the more you can get out there and publish, it's really going to help them out. And it really helps you. And Scott and I have heard in one of the corporate franchise consultant calls, this kind of stuff is going to be tied to your payout grid bonus going forward, probably starting next year, determining the 2021 payouts. So the more you can get started on this year, the easier it's going to be next year. And really the goal is to have every single client have something. Even if you just publish it out there and they got it and they can play with it, even if you're not, it's a dead client that you're not meeting with, or an AFA is trying to fumble with, just get it out there. Just have the Nike moment, just do it, and get the advice out there. So on the conversation, Scott, you said really bring it up with everybody. And so tell us what you've noticed going through it, and just the merit of doing this time and time again with all clients.
Yeah, and I think early on there tends to be, and with other advisors I work with, sometimes there tends to be an apprehensive of, gosh, I don't know it very well, I'm not very comfortable with it, all of that, it's new. And heck, just say, hey, listen, this is a new program that Ameriprise is providing, and this is one of the first times I've gone through it. I've heard really good things about it, and at the end of our conversation, we'll have a snapshot on how you might be trending for retirement. Is it okay if we take a couple minutes and go through this? And so it's okay to set it up with the client that you're going to learn right along with them going through this conversation, and they really appreciate you being humble with them about this, and it's a really nice discovery for everybody together, and it can actually build some good relationship from it.
So now that you've done many of these, Scott, I mean, what have you noticed down the road? I mean, you've had a significant amount of practice on this now, and really become an expert in this compared to others. So I mean, what have you noticed? Have you gone? What has your conversation evolved to?
Well, a lot of times at the end, we're having conversations, and again, a lot of it's people who are already retired, and we'll say, well, let's pretend you move all your money to cash. What does that look like? And so you can slide the slider back real quick, and in some cases, it shows that they run out of money at a certain age, and so, well, that's not a good idea. In another case, a client already had a bunch of money in cash, and we looked at, well, what if this cash was invested instead in a moderate portfolio? And it can make millions of dollars of difference they see, toward the end of life, and that's motivation enough for them to get moving on investing some money. So there's all kinds of benefit that we can find, and the more you learn the different types of conversations that you can pull out of the flow, you'll just pick up on more and more things as you go.
Nice. Really good insights here. So I think getting it out there, having the conversation, doing it over and over is just going to help, everyone get better at it. So, with anything new, I think if we pick those easy clients that are, whatever you say, Scott, whatever you say, John, those are great ones to always start with. I think that it's a pretty straightforward, simple conversation, just like you heard Scott go through. Walk the client through the tool, play with it, but keep it condensed, small period of time. If it's not a planning client, keep it short and simple. Don't spend a lot of time on it. But let's get this out there for everybody. Let's just publish and put the word out to people. Look, your planning clients is pretty easy to turn this on. You already have all their data. And so it's just a matter of getting it out there with the non-planning people. Go ahead and publish it. And I've seen some practices send a mass email or some communication saying, hey, this is a new tool. Let's talk about our next meeting. It's out there. It's online. So let's get it out there. Let's get it out there to the masses and push this along and keep things rolling. Of course, Scott's a D2 coach, so his email's on here if you have some specific questions for him. My email's on here if there's specific questions for me. But any final thoughts there, Scott, or any advice for the D2 advisors on how to jumpstart this and get it going?
Yeah, I think we covered a lot of it, and I do think that existing planning clients who you already have the plan done, just publish it, and then shoot an email that say, I just published this to your secure site. So that's really already done. And the publishing of the paid stuff, that's getting it, and that's different than the foundational. Foundational is for the asset management people. But really, after everything's said, we want the client to have the online experience, whether they're the planning client, the paid planning client, or the foundational. We want them to have the online experience, because if they have online experience with everything else they do in their entire life, and if we're lacking that experience with our businesses, we're very much behind the curve, and we can't afford to be behind the curve. So for the client to have that online experience in whatever relationship they are tied to us with is going to be very important.
Excellent advice. Wonderful. Well, thank you, Scott, for being on here. We look forward to hearing about your results, all of D2, and look forward to seeing a lot of you at the D2 Think Tank in Nashville. So stay bullish, publish to get it out there, and let's get some big results. Everyone take care.
Hello, D2, and welcome to the Bullish on Business series. I'm your host, Drew Watson, but in this episode, I'll be playing Detective Charlie Chan from the old school detective movies. In all seriousness, this meeting is going to be all about China. The trade tensions and simmering trade war with China have been on the headlines for the last month, and will probably be on the headlines for the foreseeable future. It appears that our side and the Chinese have hit a stalemate, and what I find is we get client questions about it because they're concerned, because for them in real life it's hard to get away from the headlines both on television, internet, newspaper, however they get their news regarding trade tensions. It's clear that over the last 2 weeks, the Dow Jones have had its worst run in probably a year and a half to 2 years. The NASDAQ has had probably even a little bit more bloodletting than the Dow. It appears that the areas hardest hit, at least in the last week and a half, have been technology related. The main crux of the U.S. issue, along with trade, is intellectual property rights. As it stands now, in order to do business in China, a U.S. company must set up a joint venture with another Chinese entity. The U.S. was wanting the Chinese to set up both a verification and enforcement mechanism in order that we can safeguard our intellectual property rights, such as patents, copyrights, software, etc., by having the Chinese institute, for lack of a better description, kind of a court system very similar to the U.S. and how we handle contract disputes. Specifically speaking, it looks like the Chinese balked at that idea, and it sent the markets into a tailspin, to say the least. So, as you can imagine, a lot of that intellectual property has to do with technology, and a lot of big technology companies such as Apple, etc., have factories in China, or they do business with other Chinese companies. So we are in a global web of trade where supply chains are synchronized, and a lot of products come out of China. In the short run, the trade dispute may have, it's going to hurt every player in the game, us and China included. But in the short term, it may affect the U.S. In a harsher way than the Chinese. What you've seen, if you follow agricultural prices, are wheat and soybeans and corn have probably been hit the hardest, along with kind of live hogs. Other areas like tech have definitely been hit the hardest. It appears from our kind of bird's eye view here at the D2 headquarters, real estate has done fairly well. Now, part of this might be real estate was coming off a really horrible 4-week to 6-week run in April, when these trade tensions kind of really simmered again. But real estate, mainly domestic real estate, has held up. Strangely enough, we see financial stocks have done very poorly regarding these trade disputes as well. Other areas of safety have been obviously U.S. utilities, especially some of the water utilities that have made new highs in the last few weeks, as well as consumer staple stocks. So when it comes to China, those areas have been a little bit more immune to what's gone on than, say, the tech sector, the financial sector, and really the industrials. The industrials were kind of the second hardest hit in all this. Some of that may be Boeing related. China could be a big market for them, but also they have their own problems with the 737 MAX 8 aircraft. So what do? One, I think it's always a good time with volatility to gauge your client's risk tolerances. Without a doubt, the high credit U.S., especially Treasury bond market, has seen a huge rally. So if your clients have treasuries in their portfolio, that would have been a positive. As I've stated previously, real estate. The other kind of trouble spot on the map has to do with crude oil prices, and a lot of that is coming out of Iran. So, since our last talk, the U.S. has deployed a fleet to the Persian Gulf, and the tensions there are running high, and crude oil has gone up. Now, we are still, as of this taping, under $63.50 a barrel, and I think the news this morning was unleaded gasoline had come down about 3 or 4 cents over the last week. But crude oil prices continue their trend up. Nothing has really spiked or gone crazy thus far, but I think it bears watching that the situation with Iran can definitely send oil prices higher. The forecast we get still call for probably $75 by the end of the year a barrel, and we'll just need to kind of watch on what goes on there. Other areas in the alternative space that finally have caught a bid to the upside have been gold. Gold did what it was supposed to last Monday when the market was down 600 plus. It did what it was supposed to the week before. Ameriprise put a paper out last week where they are calling for $1,500 an ounce, which would be about a 20% increase from where we are now. So that tends to be positive if you're using gold as an alternative in your investment lineup. Other things to note, just as we kind of come to a close here, is in the long run, and this is what I would look for in emerging markets, the damage to China may already be done. Here with the team, I've likened it to a virus. You can catch a virus, and you may not see the impact of the virus for several months or even a year, but kind of once you have it, like chickenpox. And the virus with China is, I'm sure companies like Apple and Microsoft are not sitting on their haunches and have probably reevaluated where they're going to do business and where they're going to have factories in the future. Needless to say, I think probably China is very low on their list. And I think the potential opportunities would be looking around emerging Asia for those countries that are welcoming U.S. business, such as Vietnam and Thailand, perhaps even the Philippines, Malaysia. I know India has been in talks to open another Apple factory there. So I would say in the long run, for your clients that are younger and they have the long sweep of time ahead of them, I would look at who are going to be the winners here versus who are going to be the losers. Until then, keep your eye on the ball, and we'll be in touch in July. Thank you.